Greetings and welcome to the Prescient H1 2026 webinar. My name is Zama Zulu. We are here at Prescient's head office in Cape Town, and I'm joined by the team from the investment house. Firstly, we've got Bastian Teichgräber, who is the Chief Investment Officer. We have Henk Kotze, Head of Cash and Income, Conway Williams, Head of Credit, Reza Ismail, Head of Bonds, Rupert Hay, Head of Multi-Asset, and Seiso Matlanyan, who's the Head of Equities. Gentlemen, it's lovely to see you and welcome.
Thank you.
All right, so we've got quite a bit to discuss in this session, just unpacking some of the dynamics that we've been exposed to in the first half of this year. And I thought maybe, Bastian, let's just maybe kick off with you. We've definitely experienced some turbulent times for the first half of the year. I would like to kind of get a sense from you, how have you navigated these volatile markets? I mean, I can see you all seem to look fairly fresh. You know, I'm not saying anyone losing any more hair, going any more gray. But what themes have played out in your house view in the first 6 months?
Yeah, thanks, Sama, for joining us, and thanks for the audience also for joining us. I think three core themes which I want to speak about very briefly. The first one is the stock outperformance of emerging markets against developed markets. We saw that already evolving last year, where emerging markets, or the MSCI emerging markets, beat the MSCI World by roughly 12%. On top of those 12%, we have another 14% so far in the first 6 months this year, which is obviously quite a lot for us. That's a good theme because we strategically bet on emerging markets to beat developed markets. We do think there's a lot of structural reasons why that trend should prevail. At the same point in time, we also took a tactical tilt to even more so overweight emerging markets against developed markets, which has obviously played out quite nicely. So that's quite a good one. And on top of that, also the way we had exposure to emerging markets was exactly the right way. It was on an index level, so we participated in interesting stocks like Taiwanese semiconductors outperforming dramatically, or the South Korean stock market becoming major in the index, themes which would have been impossible, as we think, to foresee, but which we captured through that close to index exposure. But on top of that, we also added a lot of alpha through CSO's portable alpha strategy. So long story short, emerging markets outperformed dramatically. We captured that, and we captured it the right way. Second big theme, which I think is important, obviously we have to speak about AI. Can't get away from that. At Prescient, being quite tech savvy in general, tech forward, we do think it's a massive trend. We use AI heavily in our investment process, but we also do think there's a lot of value creation outside of what we use it for. We see a lot of productivity gains in the real economy in the States mostly, but also in other economies. And at the same point in time, there's also, like, again, strong sector performance. Like if you look into the tech sector, you've got shares like Nvidia, whose earnings grew by 85%, which is not nothing. They also start to cash out dividends. They start to do even bigger share buybacks. So a lot of that performance is really coming through nicely, which I think is good. And again, we participated there. And then the last third theme is something which I think is also interesting. Geopolitics. We always speak about geopolitics. Already last year, it was said to be the number one theme. I want to take a little bit of a different angle on that, more like a prescient lens. Obviously, geopolitics mattered a lot last year, matter a lot this year again, but it's really important to look deeper because I think it impacts more fixed income markets than it impacted equity markets. So the earnings strengths, which stayed quite resilient in the equity space, mostly driven by the tech sector, but also driven by the energy sector, actually outperformed the tech sector this year. That's a story which is very important to keep close to heart. So yes, the headlines keep on dominating in terms of geopolitics, and yes, that is incredibly important, but you need to look under the hood to really understand what's going on there.
And just talking about geopolitics, obviously the big key event of the first half of this year was the conflict in the Middle East. Can you just kind of give us a sense of how has that maybe changed the way you view asset classes at the moment?
Yes, it has changed our view quite a lot in terms of how we position ourselves, mostly in the fixed income space, also in the equity space. But it hasn't changed because we're now taking a political stance or because we're taking a stance on what's going to happen next. It has changed because measurable risk premia have changed. And those changes we need to reflect in the portfolio. So first example would be to look at break-even inflation. So break-even inflation, let's go to the back end. So let's speak about the South African 10-year break-even inflation. It was at roughly 4% before the crisis, and during the crisis it spiked to 5%. Now it's at like in the middle because we don't know, are we still in the Iranian crisis or are we resolving it? So the market doesn't have quite worked that out. So now we're at 4.5%, which is significantly higher than pre-crisis. If we look into the 20-year break-even inflation again in South Africa. We've moved from 4.5 to 5.5 during the crisis, now back to 5. So clearly significantly higher levels than before the crisis. We don't think that's justified because a higher level of break-even inflation means that you've got much higher inflation for, and we're talking 10, 20 years. And normally, like an oil crisis, doesn't justify such a statement. So we think it's an overdone market reaction. I'm always careful to say the market got it wrong. I think the market always is right. We're more humble to say the market's wrong. But the reality is there's some mispricing happening in which we're trying to capture. So with that, we're more positive on the back end of the curve right now than we've been before the crisis. And in the income space, like 2-year space, we had been priced for interest rate cuts before the crisis. Now we're priced for interest rate hikes. Again, because now the SARB needs to rein in higher inflation expectations, which in our opinion are unjustified. So with that, the pricing of the cuts to some degree is unjustified. So that means that there's an opportunity to take duration in the front end of the curve as well, where most of the hikes are priced. So that's the second theme. And then last, also speaking about equities, first move in March when the crisis erupted, we had a 15% sell-off in our share market, which was, on a monthly basis, largest sell-off since the great financial crisis for our equity market. And that's quite dramatic if we consider that earnings actually didn't move. So you got a 15% cheap equity market after it was already, in our opinion, quite cheap. So we also picked up more SA equity exposure after the crisis, again seeing an opportunity of a revaluation there.
Okay, great. I want to come to you now, Henk. So Bastian has just outlined how the fixed income particularly has changed. That this conflict has changed your views on fixed income. But I want to come to you now because you manage a variety of income portfolios. Can you just please give us a sense of how have you managed to navigate the first 6 months of the year in light of some of the things that Bastian has just highlighted?
Thank you, Zama, and that's a great question, and Bastian's outlined quite a lot of what we've navigated and what we have done. But if we sort of zoom into what we're trying to sort of cover today, one of the key sort of topics and themes, or quote of the headline for us has been, we wanted to create certainty, so it's certainty, not complacency. And for us, that was quite a key theme if we think about what happened last year. Asset classes rallied quite strongly across the curve, across different asset classes, EM, developed markets, bonds, SA, fixed income, front-end credit. We saw strong tailwinds. Coming to the back end of last year, early into this year, the valuation cases for us, certainly if we think about being asset allocation focused on the front end, wasn't that attractive. But the key thing that was detracting from our view was this complacency theme, and really the way we pick it up is by looking at a number of different sort of factors, number of sort of elements in the market, pricing for volatility, insurance, hedging yourself against things going wrong. And that complacency is the real key theme that sort of saw us step back from too much risk very early in this year. Obviously, things unfolded. March happened. The Middle Eastern conflict came to be. Oil prices retraced higher. We saw volatility spike, etc., etc. And the valuation cases then again started to stack up to the risk we saw. And the way we would have navigated that across the curve, really early, not a lot of duration, quite defensive on credit, a lot of floating assets, front-end bank exposures, etc. And then take advantage with the repricing. So back in bonds for some of the income funds, a lot of fixed rate exposure for the money market portfolios. And as we stand, those obviously played out quite nicely for us. We saw some retracement in the back end, but the front end still very attractive. So fixed rates, as Basti said, gone from pricing cuts to hikes. In our view, that's a great opportunity. So for us to be able to fix those rates now at these levels, given where we're going to in terms of our inflation target, real yields in the front end still very, very attractive. And that makes sense for all of our portfolios. So where we do cover assets for equities, well, the pickup versus our funding is exceptional. On the credit side, your JIBAR rates, your Zaronia rates elevated, so we're getting a spread on top of that, very, very attractive. And then our back-end bonds, so we're quite constructive there, and where risk allows for it, we've taken some advantage of it. So the key here is, as I said, it's certainty that we're trying to engineer, not complacency. The complacency aspect was the key thing that drove us being active in this time, and that's the way we want to run things. So yes, we probably look all fine. There's not a lot of grey hair around. That's not because we know what we do. It's because we've got a robust, systematic process that allows us to create that certainty and not be complacent.
No, that's awesome. And I'm just thinking, particularly in your world running income portfolios, it's been interesting to see how well the bond markets have done, actually outperforming most asset classes in the local sector. Now, I actually want to now come to you now, say you saw from an equity perspective. I mean, looking at the JSE scenario, very different from what we saw in the bond space. The JSE, rose quite sharply in the first month and a bit of the year, reaching some new record highs. But as the conflict started, we started seeing all of those gains reverse. After the first 6 months of this year, the JSE is already down, 3%? How have you navigated this scenario, particularly from an equity portfolio perspective? And do you believe that the sell-off was justified? I mean, we heard Prescient say earlier, he doesn't want to say the market was wrong, but what is the view? And, is this maybe even a good buying opportunity back into the equity market?
Yeah, no, thanks, Zama. So yeah, we've often, it's been a bit of a roller coaster, and we've often heard the phrase buy the dip. Is this a buy the dip opportunity? And I don't think that is necessarily a sustainable investment strategy. It would require making a call on, which way the missiles are going to land or which way gold is going to go. So I think context is important here. So if you look at where we were, sort of February. So we were coming off a massive rally in gold and resources, which have cooled off. We also had a positive outlook, improved outlook to the SA economy with the Moody's upgrade, which which provided a tailwind for the domestic counters, but we also had the Middle East, which again, if anyone claims to have predicted which way or can predict which way things are going to go, hence maybe this is a chance to buy the dip, I would be fairly skeptical of. And the markets essentially, I think, behaved as expected, and where we are now is we're priced for more reasonably for the risk premium. So we had a shock to the energy markets, which obviously led to repricing in the rates environment, which would have been a huge tailwind for the rate sensitive, so your financials and your properties. But at the same time, we also have this balance where the domestic outlook has been improved, and it's now an opportunity to take deliberate exposure at more reasonable risk premium levels.
Okay, great. So I think between the three of you, James, you've now given us a fairly good idea of how you've navigated the first 6 months, which is great. So I think I want us now to start unpacking some of these dynamics that have already been shared. And I'm looking at you, Reza, because I want to come to you now. Let's maybe just talk about the macro landscape as a start, with you being in the bond space and focusing on that asset class. With some of these shocks, I mean, Saiso alluded to the oil shock that took place, as a result of the conflict in the Middle East. We've seen upward pressure on inflation in general. There were talks about, maybe a potential stagflation environment kicking into the system. And, central banks in general have been under pressure to consider hiking rates. And in South Africa, our MPC has already been hiking rates. Bastian mentioned, the fact that the bond market is pricing in further rate hikes. That's where we are. But when you look at the macro landscape, in your view, what do you believe is the biggest variable from a macro perspective that the bond market is maybe mispricing at the moment?
Sure, thanks for the question. Yeah, so the nice thing about studies about the term structure or looking at the yield curve is that it embeds a range of expectations, right? So you have expectations about growth, about aggregate demand, expectations about inflation, as we know, and then also it embeds expectations about the conduct of monetary policy, right? So it actually ties three major strands about the macro landscape altogether. So let's actually unpack it, and the yield curve actually offers us, some great lenses into actually what is going on, or at least what has been factored into expectations. So Bastian and my colleagues that have gone before me have already laid in a fantastic bedrock to explain exactly which instruments and which prices have responded, I guess, to the geopolitical conflict. So let's just pick up on a strand that Bastian brought out, in which the South African, the anatomies of the different experiences to the geopolitical conflict in South Africa and the US have been markedly different. Let's pick up a strand from what Bastiaan was saying, in that the South African experience has largely been break-even led. So in a classic, if you look at emerging markets in general, and some generalizations here, if you look at small open economies that have got high carry pro-cyclical destinations, they've often, emerging markets, they've responded in a typical knee-jerk risk-off fashion that has been dominated by break-even selling off, break-evens widening with the prospect of energy prices increasing. That has largely been the workhorse that has seen the most movement. So break-evens in South Africa. In the United States, the situation is quite different, and arguably the price setting mechanism is a little bit more sophisticated. So in contradisting to South Africa, the workhorse there, or the real action has happened on the real yield component, of that is embedded in, let's say, a 10-year bond, right? So, and to answer the question most directly, where I think the biggest dislocation is the size of the real term premium that is embedded in the US term structure. Now, why do we have such a phenomenon? And again, pulling through a number of different angles. Without going through the rabbit holes of the econometric minutiae, but the real term premium, just as a reminder, is the compensation that investors demand as a lockup premium for investing in a long bond, as opposed to rolling over a series of smaller bonds, right? You can invest in a 1-year bond, roll it over, and you can do that 10 times. Alternatively, you can simply invest in a 10-year security. Now, why? And the excess compensation that investors want for that is called the real term premium. Now, why econometrically does this quantity normally increase? Again, not going too far in rabbit holes, but essentially what it is, it relates to a covariance of sorts, right? It relates to the relationship between when real yields tend to increase and the state of the economy. So if it is the case that real yields, the expectation is for real yields to increase at the same time that you have a slowing or worsening economy, if those things happen at the same time, the real term premium increases. Now, why would this expectation be the case in a place like the US? The reason is because if we think about monetary policy in the face of energy-driven shocks, the response of the central bank is often to keep the policy rate on a hawkish bias, so quite elevated even in the face of what is really a supply-side shock, right? So the policy rate will remain elevated, maybe even priced for an increase, but after the initial bump, inflation will start moderating downwards. We actually know that supply shocks are actually disinflationary in the medium term. So policy rate stays stat, and inflation gradually starts to move downwards. With those things in combination, real yields actually increase. Now, this might happen at the same time as the US labor market slows down. Now, the market looks forward ahead at all of these things, and it's saying, I might have the prospect of increasing real yields at the same time that the US economy might slow down. Because of that, I want compensation. I want the real term premium to increase. So that is a massive dislocation. But as you can see, it's predicated on a range of things actually playing out. The US economy indeed slowing. The Fed reaction function indeed keeping policy rates elevated, right? And that's why you have this massive blowout in the term premium. So I see that as a massive dislocation, right? So it pulls a couple of strands together and it builds on what has already been said. But South African is a classic 101 case of simply a break-evens expanding beyond what we think is reasonable. That presents an opportunity. But the real dislocation, which is a multi-decade high, in fact, for the real term premium, comes by an examination of the US term structure.
Now, it's interesting just listening to you, Reza. You speak bond.
Yeah.
That could be a name.
Yeah, sure.
Just listening to the way you explain this whole real term premium issue, I'm even following. So
Okay. Mission accomplished.
I will come back to you a little later in the conversation just to maybe share some of your outlook views. I mean, I know Bastiaan has already touched on some of the your positioning, the curve, etc. Maybe something that you didn't touch on, but maybe you can touch on now. Duration-wise,
yes.
What have you been doing in terms of duration?
So related to the first set of comments, so Bastiaan mentioned that within South Africa, it was really, and I mentioned it as well to touch on that, was the break-evens expanding, right? So if, for example, you have supply side shocks are inherently self-correcting. A high oil price today serves as a tax on consumption. People have less residual income to spend on other things, and in the medium term, it's actually disinflationary. So for sure, for the first 3 or 4 months, you actually see inflation bumping up, motor fuel as a component expanding, but after that, you won't have inflation on top of inflation. You typically then have disinflation. So is it then correct to say that I must adjust my average inflation expectation for the next 10 years for something that will very likely resolve within the next 5 months? Right? But that is exactly what has happened in the bond market. So because of this dislocation, because of this widening, which is a typical knee-jerk reaction of, as I said, high carry emerging market localities, we saw a massive opportunity with regards to the sell-off. And we think that break-evens have widened, and we think that there's an opportunity to actually use this as a signal systematically to add duration, and that's exactly what we've done. So if we think that there's a massive prospect that the curve has moved upwards, has sold off disproportionately on the back of break-evens, where can we position ourselves for the maximum payoff, right? Not viewed subjectively, but viewed via the lens of expected returns. And that has presented itself as an opportunity to take duration and convexity at the back end. So tying into this whole story about how different yield curves and the anatomies have responded to the geopolitical conflict, we viewed the expanded break-evens as a point to actually add duration, add convexity, and take positions at the back end of the curve.
Got that. Now coming to you, Rupert, just to maybe close off this section of the conversation. From a multi-asset perspective, I mean, for you, what would you say are the standout factors that are maybe not reflected in the current reality?
Yes, I think Henk did touch on it in part, but what I'm finding very interesting at the moment is that we look at implied volatility in equity markets, fixed income markets, and currency markets. There's some very different outlooks on implied volatility right now around the world. So you'll read the news and you'll see the news online, and you might say that there's a lot of risk priced in currently in US equities, right? We get these pretty binary decisions on behalf of the president, be it missile strikes on Iran or a localized policy. But that's not priced in at all in implied volatility in the United States. So it's a pretty complacent market in the United States. Combine that with valuations which are near all-time stretched levels, and yes, that has got a lot to do with the different underlying compositions of the US index, the S&P now being a lot more tech-driven, but it's still a pretty complacent market given the valuation levels that we're getting. Just to put it in context, and we try and look at things across the board, different asset classes, you're getting a dividend yield in the United States right now of around 1%. It's incredibly low, and yet you're getting a 10-year bond yield in the United States of around 4.5%. So contextually, that means that you have to price in a lot of growth going forward, and to Reese's point, in perpetuity, in order to justify these current levels. Now, we've got a very strong rally in US tech stocks, but we're starting to see competitors coming in from Asia, repricing into the Asian markets, and that's thematically something that Bastian touched on, where if you look at emerging markets, very strong rally in emerging markets last year and this year. Volatility looking pretty much on median there. South Africa, on the other hand, and I'm not always going to be bullish on South Africa, but right now we are seeing reasonable valuations in South African equities, at the same time as seeing heightened implied volatility. So risk is actually priced into South African markets, which is often an opportunity to put on risk in portfolios. And the last thing, which is almost counterintuitive to the risk priced into SA equities, is that the rand-dollar exchange rate, more specifically on the rand as a proxy for emerging market risk, is pricing very, very low implied levels of risk. So we're looking at a rand, which is, as we know, quite it does get that whiplash effect, as do other emerging markets. Risk off in the world, you see a risk off sell-off on the rand, and yet you're not seeing pricing on implied volatility on the rand justifying it. So for us, we've actually got an overweight exposure towards unhedged currency right now, which benefits from something like a big sell-off in emerging markets, specifically currencies, when for probably the 13th or 14th time the United States decides to invade Iran.
Interesting perspective. You've highlighted something that I want us to touch on now, is this whole idea of concentration, because a number of the themes that we've been discussing around AI in particular is part of that. So maybe I'll come to you now, Henk. not about AI, but we'll get there. I think maybe that's something that is not always obvious to clients, is maybe some of the concentration taking place in the fixed income environment. And I'm specifically talking about listed credit. So in your view, I mean, does this concentration theme undermine some of the opportunities that you come across from a diversification perspective? Because most of the credit that is out there has been issued by banks. Is that something that worries you?
It's a very good question. So it would worry me if we didn't have a very strong and dedicated credit process and credit team. So we've navigated these waters before and we'll do it again. I think the broader context within the listed credit space has for a while been a lack of issuance, a lot of cash chasing the lack of issuance, and then the pricing obviously moving in that direction, right? So the compensation for the risk we would see not being there. Okay, so that's been a theme for the longest of time. Conway has, I think, spoken about that ad nauseum. I don't think he would ever want to speak about that again. But if we bring it back to sort of concentration and lack of opportunity, well, there we don't agree. The opportunity set across the yield curve in South Africa, the opportunity to find opportunities in the securitization space, front end banks, we were talking about it this morning, sort of putting home loans in vehicles, AAA rated things for money market as an example. Very diversified set of assets that you can access if you have the right process to understand these assets. Structuring ideas with government bonds underlying with the banks, giving us floating exposure, taking out some of the duration when we don't see the payoff at the start of the year, etc., etc. So these opportunities are still there. We're still finding them. There's enough diversification within that space, be it within the banks, be it one or two select corporates, be it securitization, and then Conway space in the private credit space. So we've certainly not seen a lack of opportunity. Yes, the pure listed credit market's been interesting for a while, not necessarily the place of sort of the destination of choice for us, but it doesn't mean that we don't find other opportunities, which we have been, and they've certainly taken advantage of them.
Okay, no, that's comforting to know. So maybe Conway, coming to you now as the head of credit, I just want to kind of get your sense on what we're seeing. I mean, we've been seeing the credit spreads narrow. I mean, I always wonder, is there anything left to squeeze after all the narrowing that we've seen over the past couple of years? In your view, are investors being paid to take credit risk, or is it just a matter of pricing scarcity at the moment? What is your view on that?
So I think the simple answer, Zama, is the scarcity discussion. Just to give a bit of data to what Henk said, this year alone has been about 35 billion rand worth of issuance, yet redemptions are at about 60 billion. The market last year, from a subscription perspective, that is how many bidders for every 1 rand worth of assets, was about 2.5. We are 3.7 times now. So a lot of money chasing very few opportunities. And I think where we potentially stand out is the ability to originate opportunities, not only in the listed space, to do reverse inquiries and to do the private placement. So when Henk comes to me and he says, Conway, I've got money to spend, my team and we need to go out and go find those opportunities. But the reality is that the market is quite tight. And with this, in terms of simple economics, Riza can obviously do it much more eloquently than me. You've got so many players out there. We've now seen players that have been at the margin, not even been in the space, actually going after South African credit again. The returns are there, the stability and the corporate health is there. It's not a picture where you're seeing pricing being driven by health. It's actually pricing being dealt by scarcity, which again means that you need to be very circumspect in terms of how you approach the market, which opportunities you consider or not, and where you actually find value. The reality is that there is value. We've done quite a bit of private placements. We've done the reverse inquiries. We participated in every single auction this year. And again, pricing is tight. It's pricing at the bottom of guidance, if not below guidance. Everyone wants a piece of the cake. Because again, if you compare what you're seeing from a volatility perspective across various other asset classes, and let's not talk about the liquidity discussion, because liquidity is not there when you really need it. If you just park that assumption, you're having quite stable issuers, repeat issuers coming to market, issuing of a healthy balance sheet, but again, pricing continuing to drift down. So yes, it is not the best place to be buying, but if you are selective and if you do go out and hunt, you will find the opportunities out there.
Okay, that does sound promising, but my concern is your point that you made earlier about participation in private placements specifically. We're definitely seeing other small issuers participating in private placements rather than in the auctions, the public auctions themselves. Surely this goes to create some sort of issue around pricing, discovery, transparency. What are your views on that?
So let's first go to why people do private placements, right? We've seen a lot of players into the market. Everyone needs to deploy. Not everyone can sit in cash. Okay, and if you have mandates that require you to take on a specific percentage of credit, then you have to deploy into this market. So there's been a significant uptick, and we've chatted to all of our banking partners. We've said asset managers like yourself are asking for deals in the private. It'll still be listed, it'll still be straight settled, but there is a marked increase in that sort of activity. So with that being said, very few deals on the table to do it. Yes, it's going to have an impact on pricing. But the actual interesting theme of 2026 is not the fact that pricing through private placements or reverse inquiries is getting you better pricing than the auctions. Again, that 3.7 times versus the 2.5 last year that I just alluded to means that pricing in auctions actually gives a borrower a better outcome. So I'm talking against our own book here. But the reality is, yes, there's this activity that needs to be covered, but it doesn't mean that you get better pricing. Everyone just needs to invest. And again, when there are not that many bankable opportunities, we see a lot of frogs before we see the princes or the princesses, whatever you want to see it. You need to understand what you're doing. And that's why I said the origination opportunity gives you the ability to structure assets, not only in the traditional 3 and 5 year space, which is listed probably at times inside of where Gavi is issued. Again, we should get a premium for it because you are taking an additional risk over and above that, but then also for the liquidity component. So again, it is a tough place to be. Our positioning based on our credit cycle indicator, which indicates how we should be positioned from a credit perspective, shows that we should be circumspect. We'd rather do a very solid name and extend tenor or duration to them than actually just chase. Because if you are going to be chasing, yes, you're going to be following the curve and you're going to get invested, but there's nothing like a credit event that can actually bring you back to reality. So that is the way we approach credit, very systematically and very, at this point, conservatively.
And you've seen a number of those credit events. I know you're putting it rather mildly, but we've seen the havoc that they can cause. And thank you so much for actually putting the whole price discovery point into perspective, because I sometimes get the sense that your general investors think you are missing out if you're not participating in a private placement, that you may be missing out on better pricing, but you've just clarified that that's not necessarily the case. Public auctions are usually the better option. Now, so still sticking to the concentration theme, I want to come back to now from an equity perspective. Bastian alluded earlier to the emerging market equity dynamic, how it has outperformed developed market equities. And yes, at the moment, most of that rally in the emerging market space has really been driven by two areas, Korea and Taiwan, at the back of the AI theme. What do you anticipate? Do you anticipate this theme to continue as long as the AI theme persists? This outperformance of the emerging market relative to developed market.
Yes, thanks, Zama. The concentration problem and the performance of EM versus DM, I always actually caution against the generic labels that are placed on these companies. So the true winner, as you said, has actually been AI. Right, whether we're talking developed or whether we're talking emerging market, it's just so happened that Taiwan Semiconductor, SK Hynix, or Samsung happen to carry a emerging market postal code, so they show up with the emerging market banner, but the true return driver has been this AI capex and semiconductor cycle. So the cautionary tale is to avoid the complacency of simply just looking at the labels and assuming you know the animal that's in the enclosure, but to actually go in and do the hard work of measuring and determining what the underlying driver is, and then deciding from there whether you are positioned adequately, taking into account your long-term objectives. So Basti said, and Rupert alluded to it, so we benefited from the EM rally relative to DM, but that was as a result of a measured decision to actually have exposure with full knowledge of what is actually driving the underlying returns, and not necessarily more so, you know, the labels that are patched onto the indices themselves.
I think that's certainly an important point that you mentioned, your last point about not just focusing on the labels, because I think that's what most investors tend to do. Now, Rupert, coming to you from a multi-asset perspective, just rounding off this theme on concentration, how have you then navigated this concentration theme in the multi-asset portfolios at the moment?
So we try and stay as objective as possible. So we use the numbers to build portfolios, to optimize portfolios, given the mix of asset classes that we can access. And we often had the feedback from investors, oh, you've got quite a lot of emerging market equity risk. And you could say that relative to peers, we did have more emerging market equity risk on paper, if you look at a pie chart. But talking to CISO's point, what is emerging market equities? What are developed market equities? Is it true to say that MSCI World is 70+% the United States? Or is it actually revenue driven by other countries and those stocks are listed in the United States? And yes, I mean, I won't deny that there is a lot of US concentration within MSCI World in particular. But if we take a step back to, let's say, 3-4 years ago, and we looked at MSCI emerging markets, the biggest concentration risk in terms of the geographic exposure of listings of companies was China, and by extension, Taiwan. Now, that's a lot more diversified across markets into the likes of South Korea. India's been growing. South Africa's been shrinking. And that's one theme that we have mentioned through the years in these different updates, is that South Africa makes up now less than 1% of the MSCI Emerging Market Index. So for an asset manager to carry a large exposure structurally to South African equities, and then to also comment that they would rather not carry more emerging market equity exposure, it's kind of counterintuitive, right? Rather take the emerging market exposure to access that risk premium through the cycle. I did some interesting analysis last week to see, if you look back 10 years, what's been the performance of MSCI World versus MSCI Emerging Markets. And yes, MSCI World has outperformed MSCI Emerging Markets. Look back 30 years, and there's a massive outperformance of MSCI Emerging Markets over developed markets. So really, you can pick your time period to choose your narrative, but that's not what we do here. We're trying to look through the cycle, as we always like to say, and see what risk premia can we access around the world in a very efficient, a very cost-effective manner. And we do so by investing into broad-based emerging market indices, broad-based developed market indices. Thematically right now, and we've taken off that risk in MSCI emerging markets. It has, on a valuations, pure valuations perspective, overshot the current valuations. United States, we've had risk off for quite some time. And there, I've talked about that earlier, very, very weak valuations, relying on very strong growth assumptions in the underlying markets. So yeah, having put on emerging market risk, now taking it off, back down to the long-term strategic asset allocation, banked some of that alpha, and now back to normal.
Okay, so maybe just to make sure that I fully understand, is this then not the time to be increasing your active risk? Or would you then rather go for a tighter kind of benchmark cognizant kind of strategy? What would you be doing?
I think there's, and this is maybe a bit of a not answering your question, but there's always a place for both things. Because there's always a home for a core allocation within a portfolio, and we run core type strategies at Prescient, where you're looking for your Orbi exposure, for example, on Orbi. You're not looking to take active duration. And then there's a place for a more active manager, which we run as well. Across all of our strategies, we run more active strategies, because you're looking for that additional alpha from the ability to pick asset classes or pick within asset classes, usually in the fixed income space. The biggest driver for me, at least right now, if you look at the changes we've seen in the first half of the year, the now pretty high embedded yields we're getting in fixed income asset classes, and our outlook on the global inflation coming in the next 1 to 2 years is that our portable alpha driver is pretty attractive. We're getting funding rates which are attractive relative to yields on the cover assets, which means that in the pure core type allocations at Prescient, you're getting very attractive tailwinds. Forget the rally in emerging markets, the overweights into emerging markets. Keep it simple, you're getting great tailwinds from portable alpha across our strategies.
Could I add something there quickly? So just to supplement what Rupert has said, 100% agree with him. And I think we must also put into context here, I often get this argument that indices are overly concentrated now. It's true relative to their history, but getting that argument from someone who's comparing it to a top 20 or top 30 stock portfolio, I think is actually a little bit on the ridiculous side, because we still have exposure to a broad based index, even though yes, it's been driven more and more by similar drivers now and concentrated relative to its history. You cannot compare it to a 50 stock portfolio and assume that and say that indices are becoming more and more concentrated. And then on the portable alpha discussion, which I think is even a better illustration of true diversification, is that despite the breadth and the number of shares that you have or the number of instruments that you have, what really determines diversification is the diversity of the drivers of return and volatility of your portfolio. With portable alpha, we can maintain the breadth and exposure to a specific broad market equity index, but at the same time have this orthogonal, almost completely uncorrelated source of alpha, which is in the bonds, fixed income space, credit, which is for me the definition of diversification and reducing risk.
Maybe just something that we haven't really touched on, and I'm looking at you, is private markets. And the reason why I want us to maybe just have a brief conversation on private markets is because we do see an allocation to that market in the multi-asset portfolios. And I think it's worthwhile for our viewers just to kind of get a sense of what it is that you're doing in there, what are the opportunities, etc. So we've seen, first of all, a meaningful allowance as per Reg 28 into infrastructure specifically. And I know Prescient as a house has been very active for a number of years in that part of the market, but we haven't really seen, much appetite from the institutional players in our industry, unfortunately. I'd like you to maybe just comment on what you think is maybe holding back the industry with regards to allocating more. And then just maybe a comment on, you are an active participant in the space, but we're seeing a lot of global players allocating capital to the private markets in South Africa. So there's definitely a lot more competition for you. What do you believe gives you the edge as a player, especially when there's quite limited sort of variety or limited pool of these quality assets?
So I think maybe if we start with the second question first. We're seeing a lot of more global participation or international players coming into the infrastructure, renewable, alternative space. The first thing that people think that's going to be a race to the bottom from a pricing perspective, as I spoke about in the listed space. But I think the reality is that large global players are going to be playing in the more international / large bankable deals. And then what that gives us is we'll play in the mid-market or the deals that actually require active origination. So in Rupert's lexicon, they are going to be buying the beta and then we the alpha. And that is why, while I don't want to talk my own book, we are very excited about the opportunities that are there, whether it is local community finance trusts, whether it is funding traders or funding that mid-market that hasn't actually been captured by international players that require international documentation, that require scale, that require guarantee facilities from the big international insurers. And that is, I suppose, where we believe that we do have an edge. I've spoken about origination in the listed space, the private placements, the reverse inquiries. We do that actively, but we do that more actively in the alternative / infrastructure space. And then if I want to ask Rupert, how much do you want to apply to us? There's always, can we give you more money? Can we give you more money? It's very different when you're thinking of the traditional retirement space where it is in the low digits. If just think of it, if you've got a multi-trillion rand retirement industry and only 3 to 4% of that is allocated to infrastructure, The question is then why? And that's the first question that you asked. Various myths that we've tried to dispel as a house for the last 6-10 years, talking about illiquidity and the illiquidity premium that you are actually earning, whether it is too risky for the man on the street, whether the pricing is sufficient, whether there are sufficient bankable deals and the likes, what happens in a workout scenario. So if you're just using that analogy of the beta versus the alpha, again, we go out, we originate, we find the opportunities, we have lots of coffees with a lot of people, and we deploy assets. Then we also have the ability, when there are going to be restructures, to actually do that workout. And that is where that active space, we actually harvest what everyone is talking about, the illiquidity premium. And again, this is not a bank account, this is not short-term money. So the question always comes is like, this for me is one of probably the best places to put your money right now, if you have a longer term view. Your definition of long-term might be different to my definition of long-term, of course, but the reality is if you are investing in these type of assets, you have various opportunities that you can deploy into across diverse portfolios, but then also well considered. We're not doing desktop analysis, we're going out and we're kicking the tires. We're trying to find those bankable opportunities, we're structuring it appropriately, we're partnering with the right people, and then to get developmental impact outcomes. So very excited about the space. My biggest hope is that we can dispel all of the myths and we can move that single digit low 4% to actually a 10%, because a lot of people say that Reg 28 is the constraint. Reg 28 isn't the constraint. We've got a 45% allocation available within, obviously there's sub-limits that you have to also consider, but that's a 2022-2023 problem. We are 3-4 years on and the needle hasn't actually moved. So as a house, we dispel the myths, we show the returns, we show the accrual, and I still believe, again, I don't want to talk my own book because this is what we do here, is that this is probably the best risk-adjusted return available for investors right now per your return requirements, per your term requirements that you're going to invest in if you've got the patience to actually go out and do what we do.
Great, yeah, if I can just add there, one interesting point that we have, because we've had this timeline as a house of investing, or having launched these funds so long ago now, 10 years plus, the benefit for Henk and myself is that I think of it like a pipeline. So you've got deals that are coming in, new deals that you're originating. At the same time, you're getting deals that are maturing at the back end. So that liquidity does actually exist, and yet we can take advantage of that illiquidity premium within the funds. So it's the best of both worlds.
Yeah.
Oh, no, that's actually awesome to hear. Because as you said, I mean, I think that's usually the biggest concern is the liquidity factor, and particularly from a unit trust perspective, that is something that you always need to manage. And you sound very passionate about it. I'm sure if we had more time, you would have given a lot more information on that. All right, so I think we've spoken about quite a diverse set of topics. And I think maybe it's now time to perhaps close and just kind of summarize what is the outlook for the next 6 months. I mean, we're already almost in the end of the first month of the second half of 2026. And I'm looking at you now, Bastian, because I would like you to just kind of give us a sense, looking at all the events that have taken place in the first half of the year, and based on what we've discussed in this session, where are you currently seeing opportunities for the next half of this year and maybe even beyond into 2027?
Yeah, that's a good question, Zama. Thanks, and thanks for all the contributions. I think a lot has been said. So to just sum it all up, I would like to add like an x-axis to your question. Short term, I guess the opportunity clearly lies in those elevated risk premia in the bond space, which are, as we think, unjustified at the front end of the yield curve. We see too many hikes priced. That should come down, so that gives the income or the credit portfolio the opportunity to take a little bit of duration there. The bond portfolios should benefit from the back end of the yield curve eventually compressing. As Riza said earlier, it's like a classical risk off for emerging markets, which is almost like blunt selling of the entire yield curve, which has happened. So that means there's a lot of opportunities for that to self-correct. Medium term, I think the opportunity lies also in elevated real yields again in South Africa. So even after we see that correction, our real yields will be quite elevated still. So that's great for all the credit assets, for the infrastructure assets, which Conway mentioned. It's also great for our income fund. We happen to run the largest income fund in the country. So awesome for these assets to rake out really high real returns. And then also the structural, I want to almost call it structural undervaluation of South African equities, gives us opportunities as well for CSO strategies, because the reality is that we have come off quite cheap levels to even cheaper levels. So that 15% correction in March, yes, we have reverted a little bit of that, but we do think that even at that level we were quite undervalued for SA equities, which gives you like a little bit of an overweight, which should then hopefully come through over the long term. Yes, we like global equities and emerging market equities a lot, as Rupert said, and we love diversification. But on a tactical basis, those SA equities become quite attractive. And yeah, like more structurally, that's the last positive outlook I want to give on that, as well as where does it all come together? I think the best way to put all of these views together is obviously in Rupert's space, where we run the balanced fund. We can do that at a very attractive price because we do things systematically, we do that efficiently. That's not just having a positive impact on the price, but it also comes through by combining all of these views in the possibly smartest way out there, and it is playing out in the return. So just looking at the return of the balanced fund, we are now over the 1 year, 3 year, 7 year, 10 year, you name it, almost any measurement period, not just first quarter but first decile, which is really an outstanding achievement, and the credit obviously goes to the team who has achieved it, which is everybody in this room, plus obviously the people which are not in the room. It also contributed a lot.
Okay, excellent. So maybe just the last few words from my side, I mean, having listened to all of you talk about your views, is this whole theme of certainty and not complacency, I think plays very well into how you manage money here at Prescient, with your systematic, rules-based investment strategy with a focus on, managing risk. And with that approach, you are then able to provide clients with some sort of comfort that you will be able to generate the returns and meet the investment objectives with a high degree of certainty, even though the market may be uncertain. So as long as we are not complacent, as you've all said, I think we need to just stick to the knitting. And I think may the force be with you. I mean, it's going to be an interesting next few months until the end of the year. But I wish you all the best, and thank you so much for sharing all your insights. And I trust that our viewers have really enjoyed this session. Thank you so much for watching. Till next time, goodbye.
Well, thanks everyone for joining once again. And we're going to take some questions now. We've got quite a few of them, so I'm going to read them off my screen bit by bit. The first one is, what are fixed income flows by foreigners looking like compared historically? And with 4 months to municipal elections in South Africa, how do you see that impacting fixed income markets? Henk, I think that falls squarely into your...
Thank you. And good morning, everyone. Thanks for listening. 2 questions there in one. Just on the sort of fixed income flows into South Africa from foreigners. If we zoom back sort of 12 months, we saw a lot of positive flows in the back end of last year, on the back of very positive and structurally important changes from the SARB or Treasury in terms of changing the CPI target to 3%. So we saw a lot of strong flows, and then obviously that turned around quite aggressively in March, where we saw some selling. They sold about half of the flows over the last 12 months in that period, and we've seen them come back now the last couple of months, not entirely to the same extent that they left in March, but they still they are slowly trickling back into the market. But I would say sort of structurally over the medium term, foreign flows into the SA bond market has been robust and quite good. On the municipal elections, so we try and be as systematic as possible. We do see idiosyncratic events like elections not being that important in terms of trying to just determine our sort of longer term views. And we also know that more global factors drive our market, and not something as specific as local elections, but saying that we are fairly constructive in the direction that the local politics is moving. We do see the GNU holding. We also see quite a lot of constructive, robust discussions around that. So from our perspective, it's not that important to try and predict and see where this goes, but we don't see any sort of red flags around that.
Well, thanks, Henk. The next question is on the Prescient Balanced Fund. It says, Prescient Balanced Fund has 45% global exposure per most recent fact sheet. Even though you see SA valuations appealing, please explain this, and it would infer SA exposure should be higher. On the Balanced Fund, Rupert, that's probably for you.
Sure, thanks. So close on 45%, but that has been decreasing. So we're now pretty close to 40%. In fact, we've been reducing our global exposure in favor of South African asset classes. It's not to say that we don't like global asset classes. We just think that there is a marginally higher opportunity within South African asset classes. But for us, it's always about diversification. So we're not going to switch that to being, for example, 100% South African asset classes, because we know there are exogenous risks that come through that we cannot model, and no one can model actually. So we diversify the fund in preparation for that. But we have been gradually reducing our offshore exposures in favor of South African asset classes. In particular, we've been increasing our SA equity exposure, and we've now been started to increase our back-end fixed income exposure in South Africa.
Thanks, Rupert. Next one is on emerging markets. It says or US markets actually, if robust earnings are coming through in the US, how do you capture this while still seeking emerging market exposure? Okay, I'll explain that one myself. I think what we are experiencing in the US is very strong earnings growth and strong dividend growth as well, which is obviously improving valuations. Having said that, we must be aware of the absolute level of valuations, which is actually the driver of expected returns here. So basically, yes, strong earnings have heavily supported markets, and US equities, despite the rally, did not become necessarily more expensive, but that doesn't imply that they are cheap. So that has been a little bit of a pain trade, underweighting that rallying asset class. But what we got right was to have more emerging market exposure, where we've seen a similar story. So also emerging markets didn't necessarily get cheaper. They actually got more expensive because they experienced such a strong rally, but earnings also improved dramatically. The good news here is that emerging markets have and continue to be much cheaper valued than DM stocks. It doesn't mean that they're cheap, and we're not actively overweighting them, but we are actively overweighting them against developed markets. What we are overweighting on the equity space is South African equities, where we see them as outright cheap. So that's where we really have an overweight in place. Okay, so I hope that answers that one. I'll jump straight to the next one. You mentioned tight credit spreads in South African markets. What does this look like in the global space, and how are you dealing with this? I think that's one for you, Henk.
Perfect. Another good question. So yes, locally we've seen sort of compression in your compensation for taking on credit risk. In the global space, something very similar. In fact, if you look at sort of global credit spreads, be it investment grade, be it in sort of the high yield space, they are exceptionally tight. I mean, almost all-time tights. From a financial conditions perspective, that's obviously quite good for doing business. But from a valuation case, if we're thinking about buying global credit, that's obviously not that great. So what we have seen across the sort of global allocations from our local funds, from our global only portfolios across the spectrum, is moving out of certain credit asset classes, so be it high yield credit, short duration, high yield investment grade, etc., and moving to pure sort of money market deposits, etc., as well as quite a strong overweight in the US Treasury market. So we do see quite a lot of value in holding US Treasuries across our portfolio, specifically thinking about income providers. So there we have exposures to the sort of 5-year Treasury, for global income a little bit more back-end heavy, some 10-year, and then also balancing that out with some 2 and 3-year sort of durations in the Treasury, pure Treasury space. So we also a little bit risk off in the credit space globally, just seeing valuations not stacking up with exceptionally tight credit spreads.
I think it's important to mention that credit spreads, we monitor them on a daily basis. Just been compression over the last years, but if that changes, we'll jump on it immediately, and we obviously have the operational setup to pick it up immediately. Next question is on again EM outperformance. So EM outperformed DM strongly. Is that outperformance going to last, and will we see another equally strong bout of returns in the emerging markets? I'll take that one myself. I think. Well, we obviously think that EM will continue to outperform DM structurally, because strategically there's a view that there's an emerging market risk premium, which we think will hold. It can be take a while to come through, but it normally over the long term comes through. And over the short term, we're not particularly optimistic on emerging markets anymore, because they are not cheap. But on a relative basis, we think they will continue to outperform developed markets. I mentioned it earlier, the opportunity now really seems to lie in South African equities, which is a different opportunity because it's such a concentrated market and basically relying more on resource prices. So it's a tougher call for us to make, but that's where we currently see the value. Okay, the next question, I think that's one for you, Rupert. It says, given the big moves on the rand last week on the back of the SARB decisions to hold interest rates, what do you see as the primary drivers, and do you expect this to change your house view at all?
very thematic right now. So the rand having, you could call it blowout, but let's say it's just it's increased to around 17 rand to the dollar. Why is that? Well, the biggest driver there is that we've got let's say a surprise in monetary policy from the SARB to say that they're not going to hike rates, they were going to keep rates flat. So that's important for us, because if you think about what drives markets, Bastian's mentioned that, and Henk also mentioned that the biggest driver of SA markets is in fact the global influence. So why then would the SARB have such a big influence on what the rand has done recently? Well, it's quite simple. The SARB has decided to potentially hold rates for the foreseeable future, while the Fed is priced to hike rates twice. So what that means for a currency is that your interest rate differential is now mispriced from 2 weeks ago, and your trajectory of your currency now has a different path. So it was all about adjusting towards that new trajectory in central bank policy. For us, we still are what we would call a strong negative on the rand. That means that we have less currency hedging in place, and that goes across all of our portfolios. What that means is we think that the rand has got room to weaken from this point further. And that's important just in light of, if you've got 40% or 45% or whatever the number is offshore, you are exposed to the exchange rate risk. And for us, we manage that actively through our currency views.
And the next question actually slots in nicely. They're also fixed income focused, a little bit more with a global twist. It says, you mentioned that the 20-year real yield in the United States is at a very elevated level. Where do you use this signal, and does it make you optimistic on US or South African bonds? And the answer is on both. So we see it as a signal for US, the back end of the US curve to be attractively priced. So we're seeing high real yields. Actually, the 20-year real yield in the States is at a multi-decade high, which is very interesting for us, and obviously strong buy signal. And that normally is positive for South African assets as well. So particularly for South African fixed income assets at the back end of the yield curve do profit a lot if real yields in the States are at high levels. And the way we arrive at these conclusions, why use US real yields for South African government bonds, is purely driven by science. So we test more than 400 factors on an ongoing basis, and we basically check what sticks. So basically, what are the factors which have the highest explanatory power, and we would use those to basically explain the returns, and use them to basically form our views, and with that, both of them positive. It's interesting that we are positive on SA government bonds, not so positive on the rand. So as Rupert explained, but there's no contradiction. The drivers are slightly different, and we know that the rand and our government bonds normally move in lockstep, but they can deviate. And right now, that's exactly our positioning. I think we almost out of time. We'll take one last question. I think that one will pose to you, Rupert, again, because it's again on the balanced fund. It's that your balanced fund has had a strong run on performance versus the peer group lately. Do you see this as something that can continue? I can actually answer it myself, but I'll leave it with you.
Of course, no. Yeah, so the biggest driver of performance recently has been our relative overweight into emerging market equities. So then some might say, well, that rally is now finished and you might want to rotate out of a fund like this into something else. Well, that's not quite how it works for us. What we've done is we've taken that emerging market equity risk off within the fund, because we are in agreement that emerging market valuations are now not as attractive as they were previously. But what gives me a lot of comfort in this fund, and in fact across all strategies on the board at Prescient, is that all of our underlying building blocks are backed by our portable alpha process, and portable alpha does best in an environment when yields are high and potentially can be coming in going forward. So for us, that's a really good performance driver that we expect in the next year or two, which will continue to keep the performance of all of our funds across the board in top quartile.
And then there's one last question which I will actually slot in. It's basically just a question on our global fund range. What is our best global fund in US dollars for a moderate risk taking? So it means moderate here. I think we've just speaking about our global fund range in the more conservative space. We've got a global income fund, which is extremely successful against global peers. We've got like more than 10 years of track record, done very, very well. The fund is gaining a lot of traction. I wouldn't necessarily call that moderate risk. It's like conservative. But something to look at. It's basically our version of income provider just in the global space. And then we also have a global balanced fund, which has also done exceptionally well. So we've got a small, humble global range focusing on like the core of what we do. But within that range, we've actually got exceptional performance, which stacks up very well against our peer. That concludes yeah, some of the questions we couldn't capture all of them. We will cover all the other questions which are still not answered via email. But at this point, thanks a lot for your participation and hopefully see you next time.